Students, we have studied that in the modern forms of money, the people hold money because it is the best medium of exchange to purchase any goods or services. And we have also studied that in currency form, when the people hold money, then nowadays we are holding with us some paper notes, that is called as paper currency, like that of 10 rupee, 500, 200, 2000 rupees note, 200 rupee note, like this, and with coins also. But one more modern form of money is there. Apart from currency held by the public, there is also one more modern form of money, and that is bank deposits, right? So let's take, for example, I'm going to read from your book, from your NCERT book, bank deposits or deposits with banks. The other form in which people hold money is as deposits with banks. At a point of time, people need only some currency for their day-to-day needs. So at a point of time, at a particular point of time, people do not need all the amount of money that they have earned. At a particular point of time, they need a small amount of money to fulfill the transaction or to complete the transaction by paying money for those commodities or services which they are purchasing. So at a point of time, only some amount of money is required. So if you'll see, when a person is getting salary in a month, then what happens is that he do not spend whole of his salary. Some part of the salary he used to have extra with him, we can say, out of all the expenditures from his total amount of salary, some part of money is still saved, or it is still a type of extra cash with him. So what he can do with this extra cash? I am reading from here. At a point of time, people need only some currency for their day-to-day needs. For instance, workers who receive their salaries at the end of each month have extra cash at the beginning of the month. What do people do with this extra cash? So most of the time we used to say this only. Whenever the salary is transferred to a person, then in the beginning of the month, the person is having extra cash with him. So what can he do with this extra cash? This extra cash he can deposit in the bank, right? What will be the benefit of depositing your extra cash in the bank? So I'm reading it from here. What do people do with their extra cash? They deposit it with the banks by opening a bank account in his name. So first of all, to deposit the extra cash in the bank, you have to open up an account in the bank, okay, by your own name. After opening an account in the bank, you can deposit your extra cash in the bank account. Now, the benefit of this will be what? First of all, you are having your savings in the bank, and on these savings, which is deposited in the bank account of your name, you will get interest also on it. The bank will pay you interest on it. Okay, so it is written, banks accept the deposits and also pay an amount as interest on the deposits. In this way, money is saved. So two things or two benefits are there to keep your money in the bank. Number one, you get a safety for your money. It is not in your home where a robber can come and steal your money. It is in the bank with very tight security. So your money is safe in the bank. With this, the same amount of money that is there in the bank, you will get interest also. So there are two benefits of it. People also have the provision to withdraw the money. Now, on the other hand, the amount of money that you have saved in the bank or deposited in the bank, you can also withdraw it as and when you need. As and when you need the money, you can withdraw that money from the bank. So on your demand, when you withdraw the money that you have deposited in the bank, so this type of money which on demand can be withdrawn will be called as demand deposit. So these type of accounts in which you can deposit your money in the bank and on your demand you can withdraw this money, these type of deposits are called as demand deposits. Okay, on your demand you can withdraw it. So this is a very good benefit of depositing your money or keeping your money in the bank. On the other hand, one very good facility is going to be provided to you if you open an account or keep your money in the bank. The interesting facility is this, that the facility which lends it the essential characteristics of money, that a medium of exchange. When you open up an account in your bank, then first of all you have to open your account in the bank by your own name. With this account you will also get a passbook which will keep all your details of your transactions, and with this you also get a checkbook. Okay, this checkbook is having some type of pages which looks like this, as you can see on the board here. These are the checks. A check booklet is provided to you by the bank. Now this check is going to serve you same function of money which was to be called as medium of exchange. Okay, this check will also be doing the same thing, or it will also provide you same type of service, a medium of exchange. This check will become a medium of exchange. You don't have to carry cash now. You only have to carry your checkbook or a check which you can see on the board. Without giving money, you can pay any amount with the help of this check. So this check is actually a modern form of money which is fulfilling same function which money does, right? So here if you see that most of the payments are made with the help of checks only, okay, instead of paying cash, because to carry cash for some big amount, for payments of big amounts, you don't have to carry cash. You can only take this check with you and can pay the amount of money. How can it be done? So I'm going to show you that how this is possible with the help of check. Okay, so if you see here, one example is given to you in your NCERT book only on page number 40. On this page you will see here, say for example, one shoe manufacturer is there. Okay, say for example, a shoe manufacturer is there and his name is M. Salim. He has to make payment to the leather supplier because Salim has to manufacture shoes with the help of leather only. So first of all, he will purchase this raw material, that is leather, from any leather supplier. Okay, now what will he do? To manufacture shoes, first of all, he goes to the leather supplier and asks for leather. For this, what he will do, if he has to make a big payment for purchasing that leather from the leather supplier, what he will do, he don't have to carry cash with him. What he can do, he can take the check with him. And what he will do, as you can see, he is going to make the payment of, say for example, 57,000 rupees. Okay, so what he will do, 57,000 rupees, he will write here in the box, and in words he will write here 57,000. Okay, like this he will write on the check, and This check is an account paycheck because the name of this leather supplier is Prem Kumar. So what he will do is, he will write on the first line, okay, you can see here, on the first line he will write pay to the name of the person, Prem Kumar, okay, and after writing his name, what he will do? He will cross this check by account pay. Means this check is going to be only transfer the cash in the account of the name of the person's account. Prem Kumar's account only, the amount of 57,000 will be transferred. Right? Now, what this Prem Kumar will do? He will take this check from Salim of 57,000 rupees and he will deposit this check in his own bank. And after few days, what will happen? This 57,000 rupees will be transferred in the account of Prem Kumar. So here you can see that without using cash, a big payment can be made possible. So this is also called to be as the modern form of money, isn't it? This is a modern form of money only, where a piece of paper that is called as check is serving the function of money only, right? And apart from this, if you'll see that thus we see that demand deposits share essential features of money, and the facility of checks against demand deposits makes it possible to directly settle payments without the use of cash. And since demand deposits are accepted widely as means of payment along with currency, they constitute money in the modern economy. And you must remember that role of the banks play here. So you can see here that the role of the banks is just to transfer money without making the account holder to carry cash with them, and with the help of these checks they can make payments. And very easily bank serves this check facility to their own customers, right? But for banks, there would be no demand deposit and no payment by checks against these deposits, because in the bank when you go, then you have to deposit cash only. After depositing cash, you can use the check facility from the banks, right? And the modern forms of money, currency and deposits are closely linked to the working of the modern banking system. So this you can see here that in our modern economy, this facility of check is a type of modern form of money through which our working of the modern economy mainly depends on, right? Where the transactions can be completed by using a modern form of money which is called as check. And this demand deposits facility is provided by the modern banking system only. So students, let's talk about another topic here, loan activities of banks. You can see here on the board, loan activities of banks. As I told you all that whatever extra cash we have with us, we can deposit it in the bank, right? And what is the bank doing with this cash which is to be deposited by us to these banks? So what the bank is doing with this cash, let's talk about it. Okay, so I'm reading from the beginning of this paragraph. Let us take the story of banks further. What do the banks do with the deposits which they accept from the public? There is an interesting mechanism at work here. So there is a very interesting mechanism that we are going to talk about banks here, that what do they do with this cash deposited by us. So first of all, banks keep only a small proportion of their deposits as cash with themselves. You know, whatever amount of cash is received by the bank from different account holders, this cash is not all of it is kept with the bank. No, some amount of cash is kept with the bank. That is near about these days, it is written in your book NCRT, 15% of their deposits as cash they keep with themselves. So what about 85% of the other part of the money, where it goes? So actually bank is a type of business firm which used to do business in the market with the public. They do business. How? Actually, with our money they are earning profits. How are they earning money from the public? Let's see. Let's study about this mechanism. Okay. So, as I told you, 15% of the cash is kept with them, with these banks, which as I told you about demand deposits, that you need only a small amount of money at a particular point of time, isn't it? So you do not go to the bank and just withdraw all of your money. No, you never do like this. You only withdraw some amount of money that is needed by you, isn't it? But rest of the money is with the bank. So the banks keep with themselves in cash about 15%, and whenever you go to the bank, you can get money or withdraw money from your account, some amount of money which you need at a particular point of time. Now, what do the banks do with this money which is deposited by you? The banks used to give loans. Okay, let's see the whole procedure. First of all, if you see on the board here, this is the bank here. Okay, on one side there are depositors, on the other side there are borrowers. Actually what happens is, the people who are having extra cash with them, we can say it as a surplus money. Surplus means extra cash. So those people who are having extra cash with them, they can deposit that extra cash in the bank. You can see here, these people are the depositors who used to deposit their extra money in the bank. This is the surplus amount of money with them, extra money. If you will see here, what do they get from the bank? They get interest on their deposits. Whatever amount of money they are depositing in the bank, they will get interest. The bank will give interest for it. Okay. Let me tell you about using somebody's other's property. Say for example, if you are going to leave your house and you are going to work in some other place, you are doing job in some other place, there what you will do, you will take a house on rent. If you are using the house of somebody's other, then that owner of the house will charge you money for that, for using his property, for using his house, isn't it? So you will be paying him rent for that house. Okay, so similarly, whenever any type of asset of any person is going to be used by the other, some charge has to be paid for it, right? So similar is done here. When you are keeping your money with the bank is having your money. The bank is using your money. Okay, so for this they have to pay some charge also for it. So in the form of interest, they used to pay charge for your money that you have kept, and they are using your money, right? So in the form of interest, they give you the charge for keeping your money. And on the other hand, the bank, the amount of money which is there with the bank, which you have deposited, means these people have deposited who were having extra amount of money, surplus money. The bank used to give loans to the borrowers with this money. Okay, not all of the money, because whenever you are also approaching bank for withdrawing some money, for withdrawal of some amount of money, then you can get some that amount of money from the bank, because bank is also keeping some amount of cash with them, and rest of the part of that money they are giving as loans for performing various type of economic activities. Maybe these are those people who are called as investors. Whenever they are going to open up any business, they are going to open up some type of, say, factory, then they need money for it. They approach the bank, they ask for loan, and therefore these people are called as borrowers. Right? After taking loan from the bank, they can invest their money in their business. And because these people have taken money from bank, these people will be charged with some interest also. The people who have taken loan from bank, they have to pay back interest also, right? So whatever amount of money they have taken, principal amount of money with interest, they will pay back to the bank. Now, if you see here that the bank is paying interest to the depositor, but on this side, on the side of the borrowers used to pay interest to bank because they are using the money of the bank. As I told you, whoever is using anybody's other's property then or asset, they have to give charge for it, right? And if you see here, the interest that bank is paying to the depositors is lesser as compared to the interest they charge from the borrowers. How can it be done? So let's say, for example, bank is paying 4% rate of interest to the depositors, but on the other hand, the same amount of money of the depositors, when they give to the borrowers, they charge, say for example, 10% from the borrowers. So you can see here, what should be the earning of these banks? The bank's earning is the difference between these two rate of interest, which they charge from the borrowers and which they give to the depositors. So 10% minus 4%, bank's earning becomes 6%. So this is how the banks used to earn money, right? And this is one of the way through which, as I told you, that banks are business firms which earns money from the public by taking their deposits, okay, by accepting their deposits, and this is how they earn money, okay, from the difference between the rate of interest charged by the borrowers and the rate of interest given to the depositors, right? So this is how the banks earn profits.